Well, friends, our good luck had to run out sometime. Let's talk about some rough earnings on the weekend update. All right, friends, let's talk about some bad earnings bringing some market pain. Here's what you need to know. First up, earnings season continues with some economic damage has finally shown itself. So first, let's take a look at the market, and then I'll explain to you why the market is doing what it's doing. Red here is the S&P 500, same way we've always been looking at it. Orange is the 50-day moving average. Purple is the 200-day. Now, we are still in an uptrend. It's a very strong uptrend. Everything looks good. Our golden cross is here. Everything's great, except for if you look at the S&P 500, this has been a pretty rough week. And the reason for that is we've got some adverse earnings from some pretty large companies. And so I'm not surprised that the market is doing this. I'm actually really happy that the market is doing this. If you follow along on the channel, you'll know the only thing that I'm afraid of is when the market takes off like a rocket and pulls very far away from its moving averages, because then you're kind of trapped in it and there has to be a lot of pain before you ever find support. And last week I talked about, I think we're going to enter a consolidation phase as we get through the later part of the summer, early part of the fall, and that will be okay to go sideways, to test on our 50-day, to kind of cool off the temperatures a little bit, because this market has been running hot for a long time. This has been a historic run in the last 3 months or so. I'm very happy and I welcome a consolidation phase, and I think that's what we're going to get. So where's this consolidation phase coming? Well, it's largely being driven off of earnings here. And it's not so much the earnings in the quarter that are bad, it's what companies are telling us going forward into Q3 and Q4. I think this is some of the tariff stuff starting to show up. First up, we have UPS. If you look here, earnings per share, UPS missed by 1%, revenue beat by 2%. It was okay. Earnings per share down 13% year over year, revenue down 3% year over year. So UPS is not growing anymore. And one of the biggest challenges with UPS is they said, hey, e-commerce volumes are starting to drop. And as we go into the third quarter, things look a lot worse. I think UPS was down 7-8% on these numbers. And you might say that that's a little bit of an overreaction because we beat on revenue, missed on earnings. That seems pretty good optically, but it was what they told us about the future economic activity. That's really what the market is keying off of here. UPS can start to see some economic pain. I think a large amount of it is driven by tariffs, maybe. And so the market is now pricing for that reality. Second one, this one has been a painful story all year. It continues to be bad. United Health. United Health came in, they beat on sales. Earnings per share missed pretty strongly, $4 versus $4.45. Their medical care ratio is up, which means that they're not running the insurance company as efficiently as they otherwise would. And this company set the gold standard for running insurance efficiently. And their guidance came in also weak. Sales down versus estimates. Earnings per share hit as well. Medical care ratio also not good. There was just nothing good in the United Health earnings. They're going through it right now. Now, United Health is an interesting company. I know people have very strong feelings about United Health one way or another. The one thing that I will tell you is they are the largest health insurer in the United States. They're vertically integrated. They have done it better than anybody else for years. Sometimes businesses have to go through rough patches. You can't have sunshine every day. I think that's what's happening with United Health here, but it is an interesting indicator that, hey, cost control, and these guys are the best at cost control in the medical health space is really tough to get a handle on right now. That's inflationary pressures. Finally, probably the worst conference call. They had good earnings. They beat and they had large beats versus expectation. But the worst earnings call probably went to Amazon. And I saw this on Twitter, so I included it in the chart. Worst CEO ever, Andy Jassy. It's just so funny because he flubbed a question on his call. Basically, he was asked why Amazon Cloud is growing slower than Google and Microsoft and everybody else. You know, hey, Amazon, aren't you guys a player in AI? Why aren't we seeing the AI growth out of you guys like everybody else? He basically said, this is just a moment in time. And that was enough to send the stock down. What are we, 6-7%, almost 8% today? That's a $100 billion wipeout on a flub of a question. The earnings were good from Amazon, but there were some things to note here as well. They started to say on the retail business, your Amazon packages showing up, they said, look, if costs are going to go up, talking tariffs here once again, we're going to have to push through that cost. We're not just going to eat it. And so what we're seeing is sort of like an inflationary brew, sort of like a business slowing down sort of brew. It's just a really toxic brew right now. not to the extreme, right? Things are still good. There were still bright spots. Meta, Microsoft had fantastic earnings. They went sky high after their earnings. So it's not like everything's bad, but we're starting to see the indications that, yeah, I think things are going to get a little worse as we go into the Q3 and Q4, especially after these tariffs start to bite. So what does it all mean? Bad earnings bring pain. Well, economic damage has started to show in some of the numbers. UPS, American Express, DR Horton all point to a slowing consumer. American Express is the most interesting one. That travel boom that we had post-COVID, I think that thing is over. And you're seeing stress in Vegas. You're seeing stress in airlines. You're seeing stress in hotels. So this is telling us, hey, the consumer is starting to get impacted by some of the stuff that's going on here. Data center and AI are still a bright spot. And this is why I'm not going to be worried about this consolidation phase, because data center and AI, that's pretty much the big boys, the Magnificent Seven. That is still running full steam ahead, and it's doing some pretty amazing things. So for the large companies that are basically the lion's share of the market at this point in time, they're still okay. So I would view a correction, a consolidation phase as very healthy, normal, natural right now. And this may be the beginning of a consolidation for the markets, and that's okay. Can't have sunshine every day. Consolidation would be good right now because we've been running hot for 3 months. And so what we're seeing is we're seeing a little bit more of that economic pain. I've kept this little yellow box down here. We just continue to see sort of like a deceleration from those highs post-COVID, 2021, 2022. We've seen that the economy continues to sort of glide in. Now it's coming in softly, but definitely a lot of fuel for rate cuts, and I'm sure Jay Powell doesn't want to hear that right now. So there you go. That's bad earnings bring pain. It was a tough week, tough earnings season, at least, with the numbers we got this week. I'll see you next week to catch you up on all the news. Take care. Okay, friends, that was the video. Hope you liked it. If you found it informative, good, entertaining, I'd love if you could scroll down here beneath the video and give me a like there. It helps us out with the algorithm. And then if you want to be notified first of anything new that we upload to the channel, if you come over here, click subscribe, you'll be the first to know as soon as we upload anything. Appreciate it. See you soon.